Okay, so guys, good morning once again. Mm, yeah. Once again, sorry,
Good morning, sir.
session is starting a little bit late. So my name is Hamzat Adams. I'm the instructor for this course, SAP Financial Accounting. So, but this course we will stretch it a little bit because of some of us who are not natural accountants. So we need to start from the basics of accounting while we progress to the SAP part of it. So I want us to, just like as I just did with my brief intro on it, I want every one of us to also do the same thing. So at least we know some of us on this what do you call it section. So I'll start with Mohammed. Mohammed, please you can unmute and give us a brief intro of yourself. Just a name will be fine anyway.
Yeah. Hello, good morning, everyone. My name is Mohammed Bukari. I'm an electrical engineer. But currently, I'm working with BIMS and company actually I'm a trainee as a joint venture accountant, the SAP consultant.
That's very good of you. So welcome, Mohammed. Mohammed,
Thank you.
welcome. Dania, please you can just give us a brief intro of yourself.
Good morning, everyone. My name is
Yeah, go ahead. Hello, I think Dania is okay. Kudrat, you can go ahead. Hello, Kudrat. Give us brief intro of yourself, your name, and your discipline you may like. Okay, I guess. But Mohammed, can you confirm that you can hear me loud and clear?
Yes, I can hear you loud and clear. It's just
Oh,
that
that's
sometimes it echoes. I don't know whether it's because you're using your phone as well.
okay. Is that going? Okay, that's fine.
Yes, at the end,
Okay,
yes.
that will be
But I can
adjusted.
hear you.
Yes. Oh, so SAP Financial Accounting, that's the model we want to treat. But like I said, we'll need to start it from the basics of financial accounting per se, but at least we have a brief uh, understanding of what is accounting. Brief. We will not go into detail of accounting, but it's essential we explain the components or those things that makes up accounting, so that at least when we get
sorry,
to
sir, I can't hear
it,
you.
we know what we are talking about. So this course will last for 6 days, 2 hours daily, and it's subject to some adjustment. In case where we need to, we'll do some adjustment when needs be. So this part, we'll take this accounting basically for 2 days, and it's just for us to familiarize ourselves with the basic accounting principle, the concepts and terminologies. So I'm sure you could see my screen. So as you can see from my screen here, this introduction to accounting. So what is accounting? Yeah, what is accounting? So accounting is a systematic way of recording, analyzing, and reporting of financial transaction information. This is just theory actually, but sorry, let me admit somebody. So, like I just said, accounting is a systematic way of recording, analyzing, and reporting of financial transaction. So, it's essential. Accounting is very essential for every business to thrive. But I wouldn't want to re-echo why we need accounting. I'm sure every one of us understand why we need accounting. So, when we say systematic recording, what we meant by that is that transactions are documented in a systematic manner, so businesses can track their income, expenses, assets, and liability. And this is to ensure that we have financial accountability and financial transparency. That's what, when we say systematic way of recording, that's what we meant by that. And when we say analysis, what we meant is that you need to check if your transactions has some errors, or maybe the accountings are not actually balancing. So to ensure that, you have to detect error and to give you a form of financial performance and complying with regulatory requirements. And when we say reporting, because all these things are things we structured out of the definition of accounting, because we said accounting is the way of recording, analyzing, reporting, and systematic whatever for financial transaction and information. So when we say reporting, we said in accounting, reporting helps in classifying and summarizing transactions, preparation and submission of different reports. That's what this reporting means. So whatever we are analyzing, so whatever we are recording, and we are analyzing, the end goal is to ensure that we have a proper reporting. The end goal is to ensure we make a proper reporting of our accounting, right? And that's what we meant by reporting. So, and when we say accounting, or we say financial accounting, many of us will like, what is financial? What is accounting? Right? So we have accounting and we have finance. In some company, this department are separate departments, but reporting to a particular boss, or let's say maybe the CFO now, the chief financial officer. So you have an accounting department, and you could also have a finance department. And in some smaller company, they add these two departments together, or this sub together, having accounts and finance. Some people will call it accounts and finance, or some people will just call it account department, and some will call it finance department. So what does these guys do? What does accounting mean, and what does finance mean? So when we say accounting focuses on the daily transaction within a business involving tax such as recording, reporting, compliance, and analysis. That's what accounting deals with. Their day-to-day activities involve recording of transactions, reporting it, and following the due process and the laid out principles of accounting, right? Also, they primarily reflect on company historical current financial transaction, meaning that they are big on ensuring that the historical data or postings or transactions meet the current financial obligations of the company. Now, when we say finance, as you could see from my screen, is a broader term actually, and which are often misused. When we say finance, it's often misused. Some people could say finance is things with money. Yeah, they are not too far from what they meant by that. But finances is a broader term, like I said earlier. It is for management of cash, other assets, and liabilities, and the strategically planning for future and growth of a company from high level control, right? So sometimes it is always very difficult for somebody who is just an accountant to become a CFO. It's always difficult. I'm not saying it doesn't happen. An accountant oftentimes becomes CFO of a company, but it is not just about recording, about making reports, and just giving and following the due process or the compliance of accounting. It's more than that to become a CFO. You need to understand liquidity. You understand? You need to understand liquidity. You need to know how you can interface with the banking guys, so as for your to ensure that the business thrives better, borrows money with lower credits and all those things. And they also focusing on future by using forecasting and planning. So this is what finance people do often. Yeah. So I think with this brief thing, so most times if you say finance deals with money, liquidity, ensuring that the company gets loan with a lower interest rate, forecasting for the company, ensuring that the company, doing all this sort of control and all that for liquidity. I think for the businesses rather is what the finance guys do daily. So That's just the brief, what they call it, explanation I could give on accounting and finance. So we'll just quickly go to importance of accounting in business. So accounting is the language of business. Is a language of business, right? Whether you are running a shop in Alaba Market or in Wuse or Gariki, or you are managing a poultry farm in Ogun State or operating a fintech startup in Lagos, understanding your money is the only way to grow and sustain your business. When you understand how your money is being spent, how money is coming to your account, to your account, then that's the only way you can grow as a person or as a business, right? So this below here now, here accounting, why accounting is crucial. So you need to know your business health. And when we say knowing your business health, what we meant by that is your profit and loss. So I'll make some illustration here. Imagine you sell clothes in Balogun Market or in Use or Gariki or in your corridor. You buy clothes, for 500,000 and sell them for 700,000 in a month. Just imagine probably you are buying you are buying some clothes, you are doing merchandise kind of business, which means you buy crude and you sell it, or you buy grains like maize, like rice. Maybe you buy rice from Kebbi and you bring it to Abuja to sell. You buy rice, a bag of rice in Kebbi maybe for 50,000, then you bring it to Abuja to sell for 70,000 naira. There's a difference there, right? But I don't want to go deep in that. But so the illustration we're giving is that when you buy clothes for 500,000 and you sell them for 700,000 in a month, without accounting, how will you know if you have made a profit? Yes, you could say, oh, I bought this thing for 50,000 and I make a gain of 70,000. I sold for 70,000. So I've made a difference of what they call it, 20,000 naira. Without factoring that you have actually transported that rice or maize from Kebbi to Abuja. So you did not calculate the transport cost into it. You did not factor that. You did not factor stress cost. You did not factor. And imagine if it's someone that helps you to bring it, or the person or is an admin officer who will give account of the inventories that came from rice and all that. How would you pay the person and all those things? You are not factoring all these into whether you are really making profits. So accounting will make you know if you made a profit or loss after paying for transportation, rent, or even jam fees for your children or your brother. Accounting helps you to calculate this so you know how you are spending, or so you will not be spending blindly or spending your car or making fool of yourself. Right? That's what accounting will do for you. So better business decision. Accounting will ensure you have a better business decision. Let's say you run a fish farm in Ibadan. Accounting tells you if you are growing catfish, or if you're growing catfish bring better profit than tilapia, or if selling smoked fish will earn you more money than selling fresh fish. That's what accounting will do. If you are into fabrics, or you are buying fabrics, you are buying lace, you are buying guinea, or you are buying article, what have you. So accounting will make you know which one is selling more in your environment. Which one is that when you buy them, it takes 3, 4, 5 months before you sell one material. Accounting will give you this analysis, will give you, oh, what are the products that are selling more? What are the products that are not really selling more? That's what accounting will do for you. That's when we say better business decision. So when we say avoiding business collapse, accounting would ensure if you have followed due process, if you follow the due accounting principle, there is no way. Accounting will show you that whether your business is about to collapse or is about to fail or you are doing well. So many businesses in Nigeria fail not because they lack customers, but because owners can't track their cash flow. And cash flow is king. That's what we were taught. We said cash flow is king because knowing how your cash is moving out is very essential for businesses. For instance, if an hairdresser keeps dipping into a business fund for personal use, imagine you set up a business and because you want to pay for your school fee, the children, your children's school fees, or you want to buy something in H Medics, or you want to go to Sahara store to go and buy some things. Now you dip your hand into your capital, to your fund, and begin to use it for yourself. You definitely find yourself in a deep shit because at the end of the day, you have no money left to buy new material or gari or whatever you are selling. Yeah, you have no money to buy again because you are not following the due process of principal of account, right? So the next thing is asset to loan on investment. Accounting will give you, like imagine now your business needs 2 million loan from GT Bank. or an investor like Tony Elumelu, maybe you want to buy something from Tony Elumelu, right? They will ask to see your financial record to ensure your business is viable. They want to see your financial statement of financial position. They want to see your income statement, right? They want to see your audit account or audited account to know whether your company is viable to collect this load or not. They want to see these things. So that's what accounting will do for you. These are why accounting is importance of accounting, right? So paying the right taxes. Accounting also will ensure your businesses know how much they are due or how much they are owing the government or whatever. Let me speak to the notes. The Federal Inland Revenue Service (FRS) might come knocking someday, and that's what they do oftentimes. They send you an obligation. They send you that you are having a tax liability of 1 billion or 100 billion. They will just send you an outrageous amount of money to say this is what you're owing them. So it's not for you now to look at your record, the book of your record, because you have kept some record, which is you have kept your postings or transaction in the system. So you go into your record and bring them. I'm not owing you. I've been complying with taxes. I've been complying with taxes, and you show them with proof that you have actually been complying with taxes. So if you don't have good records, accounting, if you don't have good record, you might end up overpaying taxes or facing penalty for underpayment. So accounting ensures you comply with Nigerian tax law, such as VAT, income tax, and with this, you'll be fine if you follow the right accounting principle, right? So accounting will ensure you know how much you are paying, whether you're actually paying correctly or you're not paying correctly. This is what accounting will do for you. So planning for future, accounting will also help you to plan for future. Accounting helps you to plan and budget for your businesses. For example, if you have a rice seller in Kano, right? Proper record will tell you how much you need to buy more bags of rice during the next planting season or plan for Salah celebration when demand is higher, right? And we all know Ramadan is coming very soon in early March, and people now will start stocking rice, start stocking some certain material like grains, like maize, like you start. So accounting will help you to plan, especially when you're in the business of ensuring that food, it will help you to plan, right? The next thing is preventing fraud or theft. So accounting also help you to prevent fraud or theft. What do I mean? In Nigeria, where employee fraud is a common challenge, right? Because we have that actually in Nigeria, we have that. In fact, I used to joke with some of my friends that if I start a company, in the accounting section, I will be having often meeting where I will divide some people to think of how they can defraud the company. Then I also tell some people to go and think of how they can mitigate any form of fraud. And it will be like a debate, a very fruitful debate, not because we want to harm ourselves or something, just for us to know whether there are loopholes in the business. To know, oh, tell me how you can actually defraud this company. What are the business? What are our policies? What are our accounting policy? What are our operations, our daily operations, and how we can if there is a loophole, how can you defraud the business with these current policies we have put in place? That's what I want you to know. So accounting gives you that lieu to know whether employee fraud is common or could happen. Accounting helps you to detect if someone is taking advantage of your business. For example, if you sell an inventory that doesn't match, accounting will raise an accountant should actually raise alarm any amount you are paying for any expenses you are making or for any money that is going out of your purse, you should be able to have a receipt to back it up. So these are the importance of account or accounting. It's very key. In fact, it's the bedrock. Accounting is the bedrock of every business. It's just like that. You cannot do away with an accountant. You cannot do away with an accountant. And tying it to SAP. SAP itself, if you go to the history of SAP, SAP starts with accounting. They started with accounting, and subsequently they started adding some other modules to SAP. So without further ado, without wasting our time rather, before going to the next place, which is overview of financial statement, balance sheet, profit and loss, and cash flow statements, I want us to talk. I want us to talk so that it will be like I'm the only one just speaking, right? I want us to talk. So let me ask Gania to hear his own opinion with regards to to what we have discussed so far as per the importance of accounting and why we need to keep record. We need to keep recording of accounts. Is Ghana on the call? Or
Yes, sir.
yes. Okay, so can you give us instance or an historical event that has happened, maybe a business you have done, and why the business is not doing fine just because you have not kept a proper record of accounts? Can you give us a scenario, something that could, probably maybe you have gone into a business before, and because of you not keeping proper record, you couldn't know whether you're still making profit in a month, or you have not made profits in a year or something. You don't know how to go. You don't know whether your business is really thriving or something. Can you give us a scenario?
Okay, sir. Um, so there's this business I am currently running. I don't have like a proper book of accounts. I don't record like my daily sales, my profits. I don't even know whether I'm making profit or not. So it's currently happening to me actually.
Okay.
So I hope to improve with this training actually.
Okay. So what we have said so far resonates with you because you need to. It's very, very important to keep record in everything of our life. It's very important to keep record. So when you keep record, you'll be able to know what's actually happening to you, right? It's very important. So not to dwell much on that, I think we pick one or two from this we have discussed. Mohammed, can you also give us something that made you to know that, oh, I've really made money, not just material money, like I've made money from this thing because I've kept record, or my inability to keep record has cost me for me not to, for this business to die off, you know?
Okay.
So tell me that.
Um, about 2 nights ago, there's this lady that does POS in my area. So I was just with her and she was telling me about how every night she sits down and, take records of everything that she's done. So I was curious and I was asking her, like, what's the point if you already have the transaction history? Like, you can know everything. Why do you still need to write it? She said that's the only way you can know the profit you made from the charges and everything. And sometimes she gets shortages. So the only way I know for sure is, by taking all the records and writing everything down. So it got me thinking that account is really, really important. Like, for some reason, I'm now thinking of, business from a different perspective. Like, taking records is very good so that you can make, like you said, all this business decisions and stuff and know whether you're making profit or loss, basically.
Okay, that's very good. That's very good. So I'm sure we all have issue to, like just what you said now. This also makes sense. You see, where with a local person who does POS, yes, this person makes profits from a difference, like saying maybe if you collect 2,000, it takes 2,200, and the person needs to also keep record. And also, sometimes you make mistakes. There are some mistakes. If you sit with this person, sometimes when that person he or she feels that he has made gains or he has done a lot of transactions, but yet he's not seeing that money, he's not seeing the difference. You know, it's keeping record is very, very important. It's very, very key. And it's always difficult anyway. It's difficult to keep record. It's difficult. You have done something and you want like, oh, it's always difficult. But we must ensure we keep those records. We must ensure we keep those records. If you have a notepad on your phone, just okay, I spent so, I did this, I bought this. So whatever comes into your account as salary, you can deduce from it and say, okay, this is what I'm making, okay, this is what is taking my money. I once told someone that for me, it is not food that is actually eating my money. I know where because I've kept record of what I spend. So it's not food. So I was able to know because so the person was arguing that no, food takes a huge chunk of your expense. And I said, for me, it is not food. I know what's actually taking my money. So not to dwell much on that again, I want to ask from Kudirat. Kudirat, what's your own experience? screw out on this call. Okay, so I'm sure
Yes,
we.
sir. Sorry,
Okay,
sir. I didn't
okay,
know I unmuted.
okay. Go ahead.
Unmuted. I remember when I started my interior business and I was not keeping record of sales, and then whenever I make huge sales, you know, I spend forgetting that I have expenses to do. And when it's time to make such expenses, I start looking for money. So I had to start keeping record of sales, and I managed to put my money in order, keep whatever I'm supposed to use for expenses, and then I know how to make use of my profit to do other things, so I don't have issues in my business.
That's
So
good. That's good. So, but even despite the fact that we know that we failing to keep record has actually cost us. Human being, we are very stubborn. That will not change our mind, but that will not make us to be conscious of record keeping. That would not help us. But anyway, we should, as a matter of uh, uh, truth, we should keep record. Let's take it as our daily routine. Let's keep record of whatever we are doing so that we can know if we are really making gains. Let me use this opportunity to also say something about myself. There used to be time in those days, about maybe 14 years ago. I used to play this bet ninja. Yes. I was I was I used to barb then. I used to barb hair. I was a stylist then. So I used to make a lot of money when in Gariki in area 10. So daily I could make 15,000, 10,000, it's a daily money. And I was still very young, so I was making good money. In a week, I imagine if I'm making 10,000 in every day. In a week, I'm already like 70K, Even the salary and I did not match my 2010, I'm telling you. So, but I used to play bet ninja, and if I go there, I could spend 10K in a day. I could spend 15K. I could spend one day. It wasn't even, I was still young. It wasn't that I had not gone to school then, 210. I was still looking for admission then, still battling with jam. So one day, something just got into me that, okay, let me register, let me do an online uh, betting, whatever. I registered then 1960 bets. I registered with the 1960 bet. So I put like 50K into the account. Yeah, I put like 50K into the account. So I started playing. This time I was playing with like a very low risk. What I mean is that when I'm sure that Manchester United will win, I will play Manchester United to win plus draw. Meaning that I know they will win this game, but Chelsea stay plus draw. Then the odd will drop. The odd of winning higher magic will drop. Then I'll look for another team, maybe two or three. So I will ensure I get like two odd. Meaning that if I put 100,000, I want to make 200,000, like 100,000 in return, 100% return. I started doing that. Sometime I'll put 10,000, I'll make 20K, I'll make 10K difference. I was doing that, I was doing that, I was doing that. I did that. I'll win, they'll win, they take from me. I win sometimes, they take from me. I win sometimes, they take from me. I did that for roughly 8 to 9 months. Eventually, at the end of the day, the 50,000 I put in the account got exhausted. So, see what happened. I was winning, they were beating me. I was winning, they were winning. I was winning, they were winning. But I did that for 6 months or 7 months. At the end of the day, the money got exhausted. So I could know that this is not business. So any business you go into for 6 months or 1 year and you cannot make return, rather you would consume your capital. It means that that business is not good for you or you are doing something wrong. So that was the click. That was the click that made me to realize that this bet Niger gambling is not it's not any ideal thing to do. It's not an ideal. So I'm not even looking at faith wise now. I'm not looking at faith like our faith discriminate against or not say discriminate. That's the wrong word. To say our faith says you should not do it, forbid it. Let me say, yeah. So, but at that time, it wasn't. we're still in the world, and because I was like, no, this thing is not a good business. Let me stop it. Because I was looking at it from business perspective, not as something that is, that was what made me to stop it. That this thing, nothing will. That's a logical way of even telling someone who is doing it. They say, hey, this thing is not really something viable. Apart from what the faith has even said, this is not correct. So leave it. So that was my own account of keeping record, so ensuring record that I kept then, and it was just faith. It was just luck. I was just lucky anyway to have that a system. So that system that helped me to monitor it, I will align it to say maybe it's an ERP system. So when you have an ERP system that 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 help you or that help you keep all your record, your debit, credit, and what have you, and align it to the respective node, you'll be able to know on a click, because that's what software does. Software helps you to fasten things, or makes you to do stuff for you in a very easy way, right? So instead of those is our grandfather. What they do is they read a book where they keep their journals. Okay, this expense they keep this one, this one, that, that, that. At the end of the day, there's human error, and you know they won't be able to get proper accounting. So that's what ARP does. ARP helps us, but we're not at ARP section. It's just talk that lead us to that place now. But let's continue. Let's continue our work. So now we are at overview of financial statements. Yes, we are at overview of financial statements. So if when we say financial statement, what constitutes financial statement is your balance sheet that's now being called a statement of financial position, and your profit and loss, that is P&L, that is also known as income statement. Then your cash flow. So financial statements are key tools used to understand the financial health of your business, right? It summarizes a company operation, financial position, and cash movement of a specific period. When we say cash movement, it is what we also meant is the cash flow. When we say cash flow statement, we mean cash movement within a specific period, right? Right? That's what we meant by that. So the three main financial statements are the balance sheet, the profit and loss, and the cash flow. And these are the things we will discuss. So purpose. What's the purpose of balance sheet? Balance sheet uh, shows what a company owns, what it owes, and what the owner now, which is what is the equity now, has in the business. So let me rephrase myself, or let me go back to my previous statement. So when we said a balance sheet statement shows what a company owns, what you own, which is assets in this case, what it owes, which is liability in this case, and the owner take in the business. That is what the owner of the business have injected into the business, right? I will explain. In balance sheet, we have assets. In your balance sheet, what you see in your balance sheet is assets, liability, and equity. And it's the end goal of whatever transaction will be doing, the what they call the reports that you generate after posting all your what have you transactions. So balance sheet is one of the components. So, but you may not really, as somebody who is not an accountant, you may not really get what we are saying now, but just open your mind and flow with us. And at the end of the day, you'll be able to understand what we meant. Because for whatever you're doing, there's at the end of for example, whatever transaction you're doing in the system, the end goal is to get reports. The end goal is to see reports, to see whether the business is doing fine or is doing well, right? Whether you're making profit or you're making gain. We talked about keeping records. So how do we keep records? Is what we want to discuss. How do we keep records? How do we know that this is my money? How do you know that this money is not actually your money? It's money you are owing. Yeah. These are what we will discuss in brief. So assets are resources owned by the business, such as cash, equipment, inventory, and property. Let me use example. Um, Madam Gania said something about uh, doing a business, a fabric business, or stuff. So you buy fabrics, right? You buy fabrics. But remember, when you're buying that fabrics, you are using money that in your account to buy the fabrics. That money in your account is an asset. That's why they say asset, cash are assets. So cash is an example of an asset. Cash is an example of an asset. The cash you have in your account is an example of an asset. The equipment you have, like the tailoring equipment, like your machine, your tailoring machine, your needle, your what have you, depending on how you classify your assets anyway. But in the context of that business that you just said, those machine and every other thing that helps you to, you know, to
Yes, some machinery is an
like an
asset
equipment
too.
will be seen as an asset. That's why they say equipment.
Yes.
That's why they say cash is an asset,
Yes.
equipment is an asset. Now, inventory. Inventory are also assets. Mark all this what I'm saying. Cash, equipment, inventory, and property. They are assets. Now, what do we mean inventory? For example, now, if Madam Gania, as she has said, that she does some fabric business, if she does some hijab, or maybe she's into doing some hijab or sewing clothes to sell, now she will need some fabrics. When she's buying those fabrics will come into her store as what? As inventory. Are we together? It will come in as store, as stock in an inventory account, in a store rather. It will come in as stock in a store, right? So their inventory. So it is what she owns. We said asset is what you own. So those inventory will not be those things you own. The cash will be things you own, right? The equipment are things you own, and the property will not be things. All those things constitute your property. Will not be things you own. All these things are assets. All these things are what? They are assets, right? So, and let's go to liability. Liability are things you owe. Liabilities are things you owe, right? For example, now, if you go to the bank to borrow you money, they borrowed you money. Those money you borrowed are liability to you. You have to pay back. It is not yours. You have to pay back. If you go to buy a phone, and that phone you said, I'm not paying outrightly, I'm paying small. Those small, and the phone you have bought, which is not yet your own, because you bought phone, you want to like it's an asset to you. Yeah, you bought a phone, but remember you bought that phone with an obligation to pay the money to the owner or to those who sold the phone to you, right? So that phone that you bought with what do you call it, liability that you have not paid back. It is after you paid completely that becomes your own. It will not become your asset. I'm not sure I'm explaining better, but I think you are getting me. I'm sure you are getting me. So liability are debts, obligations, loan, supplier bills, and taxes. They are liability, right? For example, now you deducted some tax from a vendor. Those taxes are not your own. You are supposed to pay government. Any form of taxes, their liability. You have to pay. You have to pay the government because they own it. The government says you must pay taxes, right? So those taxes are liability, right? So that's for liability. I'm sure we hear that word liability. Oh, this woman is a liability to me. This man is a liability to me, and that. So liability, I know we understand the concept. I'm just trying to portray more so that we get it right away. Now, equity. We say equity is what the owner of the business injects into the business. For example, if you are starting a company like Mohammed now, if Mohammed is to start a milk business like milk, now let's say Mohammed has about 100 cows in Adamawa or in Bauchi. So if you have 100 cows and you want to start a milk business, those cows are asset to you, right? Now, but before you start, you will need money to start the business now. You need money to build an office. You need money to bring the equipment and all those things. Where would you get the money from? The money is capital. So that money you have injected into the business in the first instance will be equity to you because it's your money. Imagine if you now have a friend who is also who you guys are collaborating. How money the guy is also bringing is also capital, it's equity, right? It's equity. Now, Equity, the residual interest of the owners after liability are subtracted from assets, is what makes up equity. We'll get to what we'll explain again further to understand what equity means. So you can see this pictorial image again is depicting what an asset is. Where we say asset is cash, account receivable, inventory, plant, property, and equipment. That's what P, P, and E means. Plant, property, and equipment. Inventory, account receivable, cash. I wish I could show you, which I will still show you tomorrow. I'll show you a snapshot of a balance sheet, because a balance sheet is a snapshot of your assets, liability, and equity. That's what balance sheet does. A balance sheet is a snapshot of your assets, liability, and equity, right? And under your assets constitute a lot of things. It's not just, we just call it assets. We said cash is an asset, equipment is an asset, inventory and properties and what are assets, but they have classification. Asset has classification. We'll get there. I'm sure we'll get there. But let me just use this medium to explain it. So when we say cash, the cash is current in your account. Is here. The money is here. So there's something called current assets and there's something called non-current assets. There's something called current assets. Those are the classification I'm trying to explain now under assets. We have current assets and we have non-current assets. What are the current assets? What are the current assets? We classify based on principle of accounts. We classify cash as current assets. We classify account receivable as current assets. We classify inventory as current assets. Then we now classify property and equipment as non-current assets. That's the logic and structure of assets. But when we get to where we see a snapshot of the balance sheet, you will be able to show you some of this, because see, since we are let me digress a bit. We are using IFRS in Nigeria, which is International Financial Reporting Standard. And in US and some other places, they use local GAAP. So there is GAAP. GAAP is another accounting principle. We use IFRS in Nigeria, which is an accounting principle adopted. Almost the European country use IFRS. The UK uses IFRS, but they could also have a local GAAP. Maybe you understand. We could in Nigeria too. We used to have we used to have GAAP too. That is a local accounting principle we adopted. At one point, we need to adopt the International Financial Reporting Standard, right? And that's what we use in IFRS. So IFRS has a principle with regards to how you treat your assets, how you treat your liability, how you treat your equity, how you treat your various of accounts. There are principles, and that's the difficult part of account. Account has principle. You cannot deviate from the principles. You must follow the principle for you to get your proper balance sheet and profit and loss at the end of the day. So it is principle environment or discipline. That's why many people find it difficult there. It's a principle thing. But the moment you understand the principle that govern how entries are done in the system, that's all. You are fine. You definitely have the proper account when you are following the good principles, right? So let's go back to our note, which is our script. So liability. When we say liability, we say accounts payable is a liability. We say debt a liability. What would you mean accounts payable? Accounts payable, if you see from what we have explained before now, we said debts, we said obligations, we said loans, we said supplier bills. So account payable are supplier bills. They are, for example, now, if Mohammed says, in the course of doing my milk factory, I would need water. I will need the rubber, like that's what do you call it? Like I will need rubber where I'll keep my milk. That is yogurt. Yeah, you need rubber. You need uh you need some sort of activated water to transform your milk to yogurt. Yeah, you need those reagents or what have you. So now the supplier, who is bringing you the what do you call it, the rubber and the water. The supplier who is bringing you the water is a vendor, is a supplier. So when they supplies you water or they supplies you the rubber that you use for the what do you call it, for the production of your yogurt, when they supply you those things, they've supplied you a material, but you need to pay, right? You need to pay. Do you understand? You need to pay them. So the things they've supplied is a liability to you because you have not paid. It is when you pay that they are not liability again, right? That's why they say supplier bills. Anytime the supplier gives you an invoice, the moment they give you an invoice, you have to register it first. The moment a supplier supplies something and they give you an invoice, you have to register it. So when you register it, you would, I don't want to go to the accounting entries now, but let me just, because of explanation, you credit the supplier and debit your cost. So when you credit it, it becomes a bill that you need to pay. But I will leave it at that first. Then when we get to other places, we need to explain again further. So taxes, like we say, is also liability, and debts that you have not paid, they're also liabilities. Just get that understanding. Then we goes to owner's equity. So owner's equity are capitals, like you said, capital, the money you inject to the business, you bring in your friend, maybe Mohammed brings in Ismail, or he brings in Jonathan, and they started a business. All those money they are bringing together to start a business are capital, right? Which they will expect to get their dividends at the end of the day. When the business start making profit, they want to get dividend, right? So, so now, example, I know you may not really, I just want you to, I'm making this thing very brief and very direct so that you can understand. Because the country is broader than this, but if you get this concept, you should be able to, you'll be fine when we start the, what do you call it, SAP Financial Accounting. So example, for a small retail shop, right, want to just depict something here. So an asset, they have an asset, a cash of 500,000 in Zeniba, and they have inventory item, yeah, like Madam Ganiana has machine, maybe she has sewing machine, she has another machine, all these machines, and those machines, the worth of that machine is 1 million naira. Take it as that. Now, she now has liability to pay. Maybe she has some vendors she needs to pay 300,000 to for supplying her some fabrics. So she needs to pay them. Now, at the end of the day, based on accounting principle, we say equity, what you get as equity is 1.2. How do we arrive at this 1.2? We arrive at the 1.2 because when we add our asset together and we deduct liability from it, it will give us equity. Now, let me point out something. At this point, I need to point out something. So, the accounting equation, or generally accepted accounting equation, let me call it that way, is that asset equal to equity plus liability. This is the generally accepted equation. Asset equal to what? Equity plus liability. And we have explained what an asset is. We said asset is what you own. And we have explained what is liability. We say liability is what you hold. And we have explained equity, meaning that what you have injected, literally, what you own, what you have injected rather into the business. And that's what's it called. I don't want to begin to give you what's the, but I will continue. Let me just continue. So now imagine you want to get your equity. You know, like I said, if we say this is let's say all your assets now, let's say 500,000 plus 1 million is what? It will be 1.5 million. Sorry. So it will be 1.5 million. Let me put a space here. Okay. Okay. So do this. Okay, so if we have 1,500 and we say our equity is what? Now, let's assume we are looking for equity. I know all of us should know this calculation. We are looking for equity and we have liability of 300,000. We have liability of 300,000. What will be our equity? More so, we said asset is equity plus liability. At the end of the day, your equity, which is Mohammed, Ismail, and some of his friends, who want to share the dividends, right? So literally, we are not going to deep, but we just want to use this brief to explain. We will say this, which is the asset, what, right? Because if you want to do in mathematics, we say if you want to you want to factor out something. If this is asset, I will say equity plus liability. I want to make this one subject of the formula or whatever you call it. We'll say equity. It will not be what? It will be equity equal to because this asset is here, it will not be asset minus liability. Liability. Sorry. This is what the equation, by the time you want to get your equity, it will not be asset minus liability. But the first equation will say asset equal to equity plus liability. But because now we want to know what is our equity, if you want to know what is our equity, it will not be equity equal to what? Asset minus liability. Meaning your asset is what? Your asset is 1 million, 1.5 million. Minus what? Minus your liability, which is what? 300,000. So what will be? It will be 1.2 million, right? It will be 1.2 million. So your equity will be 1.2 million. And that's what we just derived there. Equity equal to 1.2 million. You see? So that is what we meant, right? And I believe we understand this. Before we go further, I want to know whether we are together. So are we together? Do you all understand?
Yes, sir.
Mohammed, do you get this part?
Yes.
Hello? Do you get this part?
Yes, I understand.
Yeah, good, good. Okay, let's continue. So assets, we'll just give further the theoretical part of what an asset is. So we say assets in accounting are current economic resources. Or you call it tangible or intangible. So these are broader explanation or theory to what an asset means. Because assets could be tangible and it could be intangible. And that can be used to produce positive economic value. So, we talked about current and non-current assets. We say current assets are resources expected to be converted into cash or used up within a year. So when we say something is current, there are things that can be converted into cash within a fiscal year, within a year. That's what we meant by current assets. So what are those things that are current assets? We say cash, we say account receivable, we say inventory. These are things that we can convert immediately to money, right? So we now say non-current assets are resources with longer term value. We expect that this thing will over time appreciate, right? We say not expected to be turned into cash within a year. So when we buy a property, we don't expect it. We don't we want it to have an appreciable what do you call it value over a year. So this includes property, equipment, intangible asset like patents. If you have a company name, for example, now if Google is to sell the name Google, that name Google alone, that name Google, if they have to sell it, the name, not even the infrastructure, not even the anything, no, just the patents, the name alone. If they are to sell it, it will be more than $1 billion. The name alone, apart from the resources, the what have you they have, it will be more than $1 billion. So that's what we meant patents and long-term investment. So when we said tangible versus not tangible assets, intangible assets are non-monetary assets. Okay, no, they are yeah, they are no monetary asset that cannot be seen or touched, such as your trademark or your patent or your software, right? So they are intangible assets because they are not something that you can see, like your trademark now, like Adidas. The trademark Adidas, like this check mark, if they are to sell it, it will worth more than a lot of $1 billion. So these are some of the examples of intangible assets. And some of the examples of tangible assets are physical assets that can be seen, touched, and felt, like inventory, like equipment, like building, like money. These are called tangible assets. But don't stop yourself much with all this theory, this theoretical jamboree. Leave it. But just understand them, just for you to hear it that, oh, this guy talked about this thing. No. But by the time you begin to see the financials, maybe you find yourself in a company when they throw you a financial statement. And when you see it, you will not be confused as with regards to how the things yeah. So what are the components of an asset What are the components of an asset? So the component of what makes up an asset in the section of an asset is your current asset and your non-current asset. Like I said, you have current asset. This is the structure based on IFRS standard. You need to show your current asset. You need to also show non-current assets. based on reports. Yeah. So under current asset, we have cash. Like I said, we have cash, we have account receivable, we have prepaid expenses, we have inventory. These are something you need to understand, and that's why I brought this thing here, so that you won't like, how what's this? Because it will help you a lot. It will help you when you get to a business, especially as an SAP FI person. As an SAP FI person, you should, to a large extent, understand how accounting works and how they flow. Because at the end of the day, they want to see report. And so when you don't understand how these things are done, you'll be able to even you won't be able to configure their system properly. That's why it is essential we give you uh what do you call it, this foundation, so that you understand the concept of how these things work. You can't get it in one day. We do not expect you get to understand this thing in one day. But over time, when you begin to work, you begin to understand, oh, this guy, or that's just why we are saying these things. Now, when we say current asset, we've explained what it means. We've also explained what cash and where it falls under current assets. We've explained what it means and where it falls. So we say cash represents the most liquid form of assets, including physical currency. I don't need to explain much in that part. We all know what cash means. Accounts receivable. Now, this I've not explained, and I need to explain it again. What we meant by account receivable, it represents amount owned to the company by its customer. When we are doing SAP, so when we say we create liability, and we said liability are money owed, right? And we said money you are owing to a vendor or to a supplier are domiciled in your liability, right? So you create an account, a GL. I've not gotten there, but I just need to say it just to explain or to buttress what I'm saying now. You create a GL under your liability. You call it accounts payable. Then, if you are now to record the reverse, which is the customer now, when your customer is owing you. So imagine when you are owing a vendor or a supplier, when you are owing a vendor or a supplier, it is recorded under your liability, right? But when the customer is now owing you, the reverse now, when the customer is owing you, it will be recorded under your current assets, under your asset. As what? Current assets. That's what it means, account receivable. It represents amounts owed to the company by its customer for goods or sold or services provided on credit. So when you sell some things to a customer on credit, it will be recorded there as something that needs to come to your account, right? It represents the company's right to receive payments in the future. That's what account receivable means. Now, prepaid expense. Now, this one I need to also explain what prepaid expense means, because um, imagine you have subscribed your GoTV for a year. You did 1 year subscription. You did 1 year subscription and you are in January. Currently, we are in January and you did 1 year subscription. Now, you have not utilized the service of GoTV in February, March, April. These months have not even come yet. And you have paid everything. What kind of transaction, when you have to record it, those money you have paid, the February, March, April, May, June, July, that you have paid, those transactions will be recorded under your prepaid expenses in your assets. It's still your money. It's still your money. Depending on contract agreement, you can terminate it and say, please send me back my money. They'll pay you back your money, right? So it is registered under what your current asset based on the accounting principle laid back to us or given back to us. So your prepaid expense is recorded under your current assets. I will tell you how we pass some of these things when we get there. But just to make you understand, prepaid expenses are expenses that have been paid in advance but have not yet been incurred, right? You paid an amount in advance, but you have not incurred the goods or services. You have not incurred it. So therefore, it should be recorded as something that is still within your purview. They represent future expenses that have been prepaid by the company, right? Examples of prepaid expense include prepaid insurance premium. Yes, when you paid an insurance, when you make an insurance premium, when you pay, like for your car now, because we are made in Nigeria to pay insurance, to pay a third-party insurance. It is mandatory for any car, any vehicle that is moving on our federal on the road to pay insurance. That insurance you have paid is a year thing. Even your particulars, you pay in a year, right? So those kind of things are also part of your prepaid expense. The money, you understand, prepaid expense, right? So not to dwell much on this, you can read it up. Then we'll go to inventory. Inventory refers to the goods or material or product that a company owns for sales, production, or future use in operation. Like I've explained this inventory too before. I said when Aja Gania bought or Madam Gania buys in some fabrics, those fabrics, she wants to use those fabrics to produce a cloth for females or for a man. Now, these clothes that she has bought in these fabrics are inventory. So it refers to goods or material product that company holds for a sale. They want to sell. So, or if you're into a merchandise company, you buy some furniture and you resell, or you buy some shoes, you resell. Those shoes you are buying are inventory, right? Those are how to explain. That's how I can explain this inventory part. Now, when we say non-current assets, what falls under non-current assets if you are like your property, plant, and people, like we've said before now? It refers to long-term tangible assets used in production or operation of a business. So, for example, if NNPC has refinery, if they have a refinery, the equipment or all the refining product equipment rather, like their uh, column, like the column that fractionates their fractionated column, that column that fractionate their crude, their petrol, their AGU, their PMS, and all that and all that. Those equipment that you use to produce the petrol, the AGU, their property plant, their equipment, their property plants, their plants rather, or their equipment, right? So for that is a long-term thing, a tangible asset. So it will be seen as non-current assets, right? If you are into a bakery business and you have a machine that an oven, all those things are equipment. So they will be registered under your non-current assets. So we'll get to how to record all these things. But for now, we are just explaining what they meant, right? So, and we talk about goodwill. Goodwill is also under now your current asset because they are intangible value. So now let's look at liabilities. Let's look at liability. Liability, like we've explained this thing too, we've explained this part. I wouldn't want us to dwell much on this thing so that we can round up. I'm sure you understand what liability means. I'm sure you also understand what current liability. So under liabilities too, we have what we call current liability, and we have what we call non-current liability, right? Like we said, current liability are obligation expected to be settled within a short period, typically within a year. That's what current liability means. They are obligations that need to be settled within a year, right? So like account payable now, it's expected you pay your vendor or your supplier within a fiscal year. It's expected, but sometimes, but you are supposed to pay. So non-current liability are obligation not due within the next year, like loan, bond. Some of the loan you borrowed some money from the bank and you are not really paying back maybe after 1 year or 2 years, maybe based on your agreement. So this can be recorded under your these are recorded, not can be recorded. These are recorded under your current liabilities. So the component of liability, sorry, yes. I'm sure we can hear each other. Okay. So component of liability. 1 minute. So current liabilities, accounts payable. So we said in liabilities we also have current liability and we have non-current liability. So what are the things that falls under your current liability? We have explained what account payable means. So accrued expenses are expenses that have been incurred but not yet paid, right? So when you get some things from the what do you call it, from the supplier, right, or the vendor. So you need to post when you buy anything, any transaction, you need to record it. You need to record it. And so sorry. So you need to record every transaction in the system. And as such, your accrued expenses are recorded under your current liabilities, like your supplier invoices. You record it under your current liability as an accrued expense. So you put the debit to the expense or to the expense of the cost. When I say expense, I mean cost. You post a debit to there and then you credit your vendor. I also tell you the principle around your double entry. We'll get there. We'll talk about double entry. We'll talk about when do we know we are supposed to debit this and when do we know we are supposed to credit this. We'll get there. So then we'll, you can read up this, but I think we've said a lot about these current liabilities things. Accrued expenses reflect the company current liability, fair financial position. I think we now on end revenue settlement received from customer for goods or services that have not yet been delivered. So all this story. But it's here just to for you to have a glance of what it means. But I'm sure we understood what this means when we are explaining all these things. We've explained both current and non-current. It's just a snapshot for you to also go through it again and read. Because I've explained it before. So let's leave that and go to your shared equity. So we said shareholder equity represent the residual interest in the assets of the company after subtracting the liability. Like you remember we did some arithmetic where we said, since we said assets equal to equity plus liability, we now said we need to get your equity. You just simply transform the equation to say equity equal to what? Assets minus liability. That's when you transform the equation, you get your equity. So after subtracting liability, it reflects the owner's claim on the company resources. So when you want to know how much, depending on your percentage, if you say if Mohammed now as a shareholder in the company has 50%, and Ismail, who is his friend, is also have 50%. Now, when they are to share the money, after getting what is the equity, after knowing what is the standing, the position of the equity, they can share the money and say, okay, 1, 2 that we said, we share the money to 600,000 naira. Ismail will take 600,000, and Mohammed will take 600,000 naira, right? It's as simple as that, but it's not that simple anyway. But just for us to have an understanding of what it means. So that's what we mean by shareholder equity. Now, what are the components that makes us shareholder equity? We talk about share capital. Share capital is the value of fund that shareholder have invested into the company. When a company is first formed, shareholder will typically put in cash. You know, I've explained this thing to before. We said when Mohammed and Ismail are coming together because they have intention to have a like a BB yogurt. They want to have Mohammed and Ismail Mohammed and Ismail yogurt. Maybe that's the name of their company. They want to have Mohammed and Ismail yogurt. So when they want to form this company, they will not just form the company with mere say or just saying it. They need to bring money together. They need to bring in fund. So the fund they are bringing together is what? Is the share capital they are injecting into the business. That first money they are bringing the capital, now, that's the share capital they are bringing. So these are the components. Those are the things that makes up the shareholder equity, right? We talk about retained earning. I know we've not really talked about retained earning, but let me explain what this retained earning is. So retained earning is a snapshot of your P and L. When I mean P and L, meaning your profit and loss. Retained earning is the what? Is the snapshot or the difference. Let me say the difference between your, let me use that word difference. The difference between your profit and loss. What I mean difference is that whatever comes in, what will flow into your retained earning is your what? Is your profit and loss. So it will be profit minus loss. So the money you have made minus the expenditure you have incurred will make up your what? Your retained earning. That's what comes in under your retained earning. So under your shareholder equity, some of the components or the structure that makes up your shareholder equity is share capital, retained earning, and dividend payments. These are some of the things that makes up that environment, that structure. So we'll talk about retained earning. Let me just use the theory. It said, is the total amount of net income the company decides to keep every period or company made one dividend. So these are theory. They are story. But just for you to get it, what we meant by retained earning is that your profit minus what? Your expenses. Your profit minus what? Expenses makes up your what? Your retained earning. Simple as that. Now, dividend payments. These dividend payments represent the portion of the company's net income that is distributed to shareholder as dividends. Dividends are payments made to the owner. Do you understand? When we say dividend, you know, I said something dividend before. I said something about dividend. You know, I said something that dividend is the money that is paid to the shareholders. So, like for example, now PLC companies like public limited liability company, public limited liability company. There's PLC companies like Zenith. Zenith is a public limited company. First Bank is a public limited company. Owando, Dangote Group is also Dangote Sugar and all those things. They are public limited companies. So there are people who have bought their shares. A lot of people have bought shares in Dangote and some of these companies. Now, every year it's expected that after going through their financials, they've looked at their assets, they've looked at the what have you, all these things, they've come up with the end result. So they need to look at how much are we to share to our shareholder. Are we making profits? If they have not made profit, there's nothing to share. But if they made some sort of profit, they will need to share some sort of dividend, right, to the shareholder. And that's just what is dividend. So it's also a component that falls under the shareholder equity part. So I think that's that for what do you call it, for shareholder equity. But I think at this junction, I want us to ask questions. I want us to ask questions so that we can. Hello? Do we have any question at this junction, or we should just continue? I just don't want it to be something that I'm the only one just talking. I want it to be conversational, so that at least we are not sleeping. At least we are getting what we are talking about. Or do we have any question?
No, personally, I don't have any question. I don't know whether the rest knows.
Okay. So if we don't have any question, I might
No
want to ask.
questions, sir. You can continue.
Okay, no question. Then I want to ask question. So I'll paint a scenario. I want us to identify which one is the asset, and which one is the liability, and which one is the equity. So imagine you buy some generator, or if you buy some generator, or you want to resell, or let's assume, okay, let me paint it this way. There is a company, right? The company is a service company. The company is a service company, like let me say like ADC. ADC is a service company. So they service the populace, which is the citizen, with electricity. Now, this electricity, they themselves buy this electricity. They buy this electricity. Yeah, I guess somebody's out. Okay, I think. Okay, so welcome, Mr. Innocent. So AEDC is a service company. They buy electricity and they resell it. They resell this electricity to Nigerians. Now, this electricity now, this electricity, okay, the first thing is that the electricity they bought and they resell to Nigeria, the electricity, is that an asset or a liability? Daniela, hello.
Yes, sir.
Yes, can you speak to that?
Okay, so the electricity they bought, to them is a liability. Sorry, to them is an asset. Then them selling it, what can I say? To them is a liability. Them selling it to us is an asset. Selling it back to us is an asset. I think that's what I can say to that.
Okay, okay. Mohammed, so AEDC bought electricity from, let's say, Mbet. Now they sell this electricity to Nigeria. The electricity they bought, is it an asset or liability?
Well, since they already bought it, I think it should be an asset. It's something they have, they own.
Okay, okay, okay.
Said
So
they already bought it, so it's like an inventory or an asset, like current asset. So
Yeah,
I
I'd
think
say
it's
it's
an
a
asset.
current asset.
Exactly.
so Mr. Innocent, you may want
Yes,
to explain this
good
part to us
morning,
again.
everybody.
Yeah. So we just illustrated something. We just explained before you joined, we were explaining the components of accounting. We were talking about the structure or the principles that govern accounting, like the asset equal to equity plus liability. We've also explained what asset is. We've explained what liability and equity means. We've explained why accounting is important. We've also given definition of accounting. So these are things we talk about. If you look at our screen, I think we just see some of the things the snapshot of things we discussed so far. So I paused and I asked if there are questions that need to be asked before we go to profit and loss statement account. And so I'm asking a question now, just to know whether we understand what asset means, what liability means, and what is shareholder capital. So then I made an illustration that AEDC buys electricity from Embed. Now they will sell the electricity to Nigerians, right? And even AEDC themselves, they have people who have invested into them, like who have injected some capital into them. So I asked us to identify which one is an asset, which one is an equity, which one is a liability. The question may not be phrased properly, but I think you could make justice. Please help us make justice to this question. Which one is asset, which one is liability, so that we can learn from it.
Hello, can you hear me?
Yes, we can hear you.
Okay. If Embed AEDC bought let's say power from Embed, right?
Yes.
Now, the context here, it could be asset, it could be liability. If AEDC power without paying, or they bought it to pay later, that would classify at instant or pay. So they will record it in their books as liability because they are owing Embed. Mind you, Embed is one of the regulatory body of the government which saddle with the responsibility of selling power to respective companies, stakeholders who wants to go into purchasing of power and reselling. So AEDC will want to resell it to me and you. Now, if they buy it from them, that means it could be cash, it could be on credit. So if they buy it on cash or they pay outrightly, that becomes an asset to them. But if they have not paid yet, it's a liability to them because they are owing Embed. So it could be, okay, let's look at it from an outright payment. If they pay outright while buying, it's an asset to them. So I think it's a straightforward question. Now, how to keep these things is another context. They could keep it as inventory. They could keep it as assets held for sale because they want to sell it to realize back what they purchased, which will result in having profits. And you can look at it in another perspective of capital investment. But let's not go that deep because it's a context of what's simplicity of your equity. So when you are buying to invest, that's where you are looking at it from equity perspective. But when you are trading, you look at it from asset and liability perspective. I think it's as simple as that. Let's not compound it to become complex for understanding purpose.
Thank you very, very much. You see, when an accountant speaks, it is easy to know that this person is an accountant. So Mr. Innocent has actually made justice to this to what the question we have said. In fact, he should be the one to even take us this financial accounting module while the another instructor, like while I took the SAP part, he should, because it sounds what he said so far justify what we've been talking about, and we'll continue to profit and loss statements. And since Mr. Innocent is here, I don't know if Mr. Innocent has a little time around him there so that he can just walk us through these profit and loss statements, explain what profit and loss means, or what we call income statements in Nigeria. So, Mr. Innocent, do you have the time to just walk us through this profit and loss of the thing?
Okay. Let me. I'm on another task, but I just stumble into this, and thank God for the professionalism. Let me buy time into this. Like the word profit or loss, which is income statement. Every business ventures today for a purpose to gain something, wealth. And that wealth translates from you doing one or two activity within your organization so that at the end of the day, you will create a wealth. That's from the economic perspective that drives us into accounting. Now, income statement, as simple as it is where you have to derive your revenue, costs, and expenses during a specific period. It can be quarterly, it can be monthly, it can be annually. Now, when that happens, you try to, you try to put those records, activity into records by analyzing all what you have traded or all what you have said during the period. Now, you have sales and you have income. Sales is what you have put into activity and realized. Those things you put into activity by trading are your sales. The income is the realization of those things you did. Those are the income. And the statement itself is the record or the information which you bring into bear by putting them into analysis, data analysis. That is the income statement itself. It has a structure. It has a structure. You have the income, you have the cost, you have the expenses, and you have the revenue. Now, in a simple structure, let me bring it to a simple accounting. When you want to do your income statement, it carries the format of revenue, and your revenue are those items you traded, your sales you traded, and those other activity outside the company trade that also yield profit for you. Those are your revenue. So it could also be divided from the tax perspective from your earned and unearned income. While your costs are divided into two. Your costs are divided into two. Your cost of sales and your expenses, which are expenditures from another perspective. So accounting term, as I'm breaking them down, you will discover that meaningfully they are revolving. So in a simple context, when you say cost incurred to run the business, it's divided into two. You have your cost of sales. These are direct costs that you incur while trying to sell. So they are direct costs, like your raw material, your labor, your direct overhead costs. Your salary are direct costs, but in accounting wise, we put them as expenses. So they are. It's a very critical part of accounting. But let's take it as simple expenses. When we get to that higher level, we'll break salary down. That makes it to be fixed or current cost. Then, when you do that, you now have your gross profits after your sales and cost of sales. You have your gross profit. Your gross profit is a net of your cost of sales. Then you now have your expenses, which are your running costs, administrative costs within the organization. That gives you your net profit. In a simple summary, that is your income statement. That's the simple summary of that. So when you look at the slides from my higher fellow here, which I give a hand to, the revenue represents the total amount of money generated from the sales of goods and services by the company. And it's a key indicator in the company's ability to generate income, growth of the business. So for every business to exist or to continue, that's continuity. Without revenue, you can't do anything. You can't just be having costs and you grow. You liquidate or you bankrupt. You file for bankruptcy. So that's a simple analysis there. Why cost of sales, we call it the COGS, the cost of sales, represent direct cost. I have explained that before. Your raw material, there are three key components that make up your cost of sales. You have your direct labor, direct material, and direct overhead expenses. Those are what drives the sales, what drives the company activity that results in sales. They are direct. Then you have the indirect. The indirect are the operating costs. The operating costs, which are the expenses that you spend day to day, like your printing, rent, salary, business development, transport, fueling, repair and maintenance, which are which are indirect. So from this, you now have, you can call it like the gross profit are indirectly called operating profits. In the context of production process, you have operating costs, and in the context of service industry, you have gross profit. So depending on the nomenclature of the industry, which are seen. So you have other incomes, like your other incomes are the income generated not directly from the business, but because you have established that business, other activity might come. Say you have a building, and that building, because you cannot use the entire building in your business, you subletted part of the other part of it, business environment, that income. You can see your discounts received from selling this thing, from discount received from businesses, which as a result of you facilitating the sales of products. It could be other income. Your bank charges, because you have opened an account and you make lodgements time to time, you discover that those money, because they are fixed there, they generate income on their own, not because you are trading or you are doing business. They are other income. You can, like valuation, revaluation, actuarial. Sorry, I'm going that far. Actuarial are pension that a company have with a bank. And because they deposit those pension money with the bank, they generate interest to the company. Before those money are being lodged to the custodian, they are actuarial gain. It could be lost. So in a nutshell, those activities that you do outside the business that generate income are called other income. The same thing with other expenses. Just the same similar way I explained other income, that is how other expenses flow. Then you have your taxes. Your taxes as a business entity, taxes are key to every business because they are compliance activities. When you make sales, there are VAT associated to them. When you make purchases, there are VAT associated to them. When you want to give an account of your returns to the government, there are taxes associated with it. So that takes us to different forms of taxes. You have VAT, you have withholding tax, you have CIT, company income tax, you have EDT, educational tax, you have police trust tax. So those taxes, they are all part of taxes that goes out from your company as a result of value addition to it. Then the withholding tax is one of the key ones that is separated. Withholding tax is, we call them We call them tax from the deducted from the source. Why are they deducted from the source? They are a form of credit to you because when you sell, they tell you that they are withholding withholding tax. It is not they are withholding it, they will put it in your pocket. No, you will use it to offset whatever liability you have in the future. So that's in a nutshell. Let me not go deep into that because of time purpose. So here there are examples here, which in what I have explained must have covered all these examples. I can tell you, you have a revenue of 500,000, income from catering service. That means you are into catering. And catering is like, can be divided into food preparation and selling, cake baking, and other events that result to making small chops and big chops, depending on the chops you want. Then expenses, you have 300,000, food, labor, and transportation, which you have spent in the course of catering events. Then if you do 500 minus 300, the revenue minus the expenses is the profit. That is explanation of what it is here. Now, that's example number one. For cash flow are liquidities. When you say liquidities, I'm using the higher terms. I know we are professionals. Liquidity are short-term activities in and out within an organization. That is the liquidity. So it's a flow. And how does it flow? It flows in of the business and out of the business. When you have your current assets, they come in. Current liability, within a short period, they go out. So when you match them, if one is higher than other, it could tell you how the business is transforming or how the business evolves. You can be able to control what you receive and what you spend by having a savings or a budget. That is cash flow purposes. Now, the tricks to movement of cash flow to operating, investing, and financing. Like the liquidity I just mentioned of your current asset and current liability falls under operating activities because it's more of cash generating and cash spending. Then, when you are buying a fixed asset or equipment, or when you are leasing, when you are spending to rent an equipment for the purpose of you trying to invest to get more money, that brings us to an investment activity. So more of cash investing, they deal on more on what I call it, more on equipment. Basically, the investment activity falls. Then the financing itself falls on when you are opening a business and you don't have funds to run that business. You need someone to give you money. That is where the accounting equation falls. So that you can be able to finance that business. In the course of doing that, you borrow from either bank to run that business. And there is a covenant. A covenant is an interest or agreement to pay back something for collecting something from somebody. And that covenant is like repayments. So you have to do, they have to give you a payment plans to do that. The same thing with dividends. Now, when you do that, remember that in a business cycle, you have equity, you have assets, you have liabilities. When you borrow, it becomes liability to you. You are saddled to pay back that person. You are investing, that money comes in form of capital to you, but it's a borrowing. Now, if it's a one-man business, it is you and you alone. But when you involve other people in doing that business, you need to pay them something in return when the business grows. It comes in form of interest to them or dividends. That is financing activities. I think in a nutshell, I just explain everything about this. Now, This is the 3 benchmark for cash flow. So with this, you can be able to understand how cash flow activity goes. So there are examples here from my brother's slides here. The operating cash flow is like you receiving 1 million naira from a client. When you receive that money, it's an operating activity because that money comes to you as an inflow. But when you buy an asset, a machine, equipment, you are investing. It goes out of your company. It's an outflow investment. Why financing is like you collecting loan from a bank to be able to finance your business so that it can grow and yield better returns for you to be able to pay dividend to the owners of the business, or you yourself, you now have more profit to keep to yourself. That is financing activity, and it's a cash flow of its own. I think that explains all these slides for us. Mr. Adams, I hope I am flowing with your concepts.
In fact, you have done justice to more than what I can now. In fact, you have broken down.
So yeah, I am doing this in a more professional way so that when they leave, they will understand this. If they go to any book tomorrow, they might not see most of these things I speak. So they are knowledge-based, which you as a fellow, you understand. Thank God for that. So after this, you will now discover that cash flow for every business to exist, you want to work on as an accountant. They employed you and they say, how can we manage our cash flow? What you want to look at is this. For you to be able to manage a cash flow, do we have money on ground? If no, then there is nothing to manage. How do we have money? That is, as a manager, that is what will be sticking in your hand. We get money from the primary place where the company needs money is from the sales. That is the first point you need to look at first. What are our sales? How does this money come in as cash flow? Is it good? Does it come well? If no, as an accountant, you need to look at that area, structure it. You could be a marketer because you don't just sit down on your system and start posting because you are posting. No, those are areas for you to be a manager. That's why you are a manager. Now, when you look at that area, if the cash generating is not enough to run the operation of the company, there is a problem. The business might crash. How do we increase our sales? We will increase our sales by looking at a higher production and look at a wider market. When you do that, secondly, how do we fund it? You can fund it 2 ways, internally or externally. That takes us to debt and equity. Internally is equity. The owners of the business, you tell the organ, we need this money. If you have any money outside there, bring it in, inject it into the business so that we can produce more to sell more. But when there is none, let's look outside. You look for brothers and sisters outside, or you look for bank, financiers who will bring in the money at an interest rate to be able to finance that business. I think that's a summary of all these things, a key component of this. So with this, we can move to the next item from the slide.
So thank you very much, Mr. Innocent. In fact, all the things that constitute financial accounting is what you have summarized in one. So we've talked about the balance sheet, we talked about the P&L, we've also talked about cash flow. Now tomorrow, Sunday, which is tomorrow Sunday, what we'll be looking at is we'll create some scenarios with the intention of getting to balance sheet, like an exercise, like saying, okay, somebody brought in capital into the company, will be seen as equity. We'll post the entry. We'll also explain the double entry accounting principle tomorrow. We'll also explain when we debit an asset, what happened. When we credit an asset, what happened. How do we even treat assets? How do we treat liabilities? how do we treat receivables, and all those things. These are the things we'll discuss tomorrow. So today we've
Okay, in a nutshell, yes. Okay, sorry. In a nutshell, before we discuss that tomorrow, I want to give them a homework.
Okay. Go ahead, sir.
I love working. The structure of a balance is divided into four. You have the assets. You have the assets. Well, you have the assets, equity, and liability. That is how the IFRS stated it. Assets, equity, and liability. But in our own understanding, so that I will not go this far, you look at it in a three-border way. You look at the asset, liability, and equity. All of them revolve. In a professional way, you call it non-current assets and current assets. That make up the asset itself, which are called property, plant, and equipment, PPE. So that is just the summary of assets itself. Then the liability itself, you have the current liability and the non-current liability. Then you have equity. Equity are owners' funds. Because equity are owners' funds, they are divided into shares of the business. When equity is injected, you will discover that money to trade, to do activity comes in. So that is the simple scenario of balance sheet. And balance sheet itself is an old name. It's called statement of financial position. That is the new name. So I want us to be speaking in a newer terms as a professionals, colleagues to be. That's just the summary of what we will discuss pari passu, all examples relating to the one by one line item that make up that balance sheet. You have the cash, the bank, which are cash and cash equivalents. Thank you very much. I think we have so much. If I want to discuss, we will not leave here today.
Yeah, thank you.
All right, thank you, Mr. Adams.
We appreciate your input. Input is one in a million. So I want to ask questions. Do we understand what Mr. Enoted have explained so far? And if you have any question, please bring up your questions. Let's deal with it before we end this class.
Hello, sir. Sorry, sir. I didn't get the part where you said you wanted to give us an assignment. So I don't know what the assignment is about.
The assignment is looking at the balance sheet structure. I have even broken it down. What is the new IFRS balance sheet structure? As an accountant or manager, you should be able to understand that. And I also explained that to you. So it will help you to understand. You have your PPE, property, plant, and equipment, which is divided into current and non-current assets, your liability, current and short-term and long-term liability, and your equity. So when you understand that structure, look at it from balance sheet, a simple balance sheet, you will see more than 20 items, but they are grouped into this 3-line item. So when you go and review it, when we are discussing tomorrow, you'll be flowing. Thank you.
Okay, sir.
So any other question? Please ask questions. It's very important. I'm very good at asking questions. That's where I understand the unknown. All these things we are discussing are structured into system. As an accountant, if you understand this, when somebody say, we made a revenue, you know that you are crediting sales and you are debiting the vendor. It's very simple. Sales is a credit balance, and in a balance sheet, you will see as revenue is a credit balance in the balance sheet. It's a balance sheet item. Sales is a balance sheet item as a revenue item. So when you are doing your business profit and loss account, you will discover that there is a net effect in the balance sheet of that item. It goes there as a credit balance assets. Bam, and sit there. So one thing is here, the other one is here. The simple accounting entry is that for every debit entry, there's a corresponding credit. It's one of the golden rule. So if you understand this golden rule, it will help you to digest every accounting area. Once they say, just look at the golden rule, you have the solution. So go and understand that golden rule. Tomorrow I will sing it. The golden rule in accounting. I guess we are all managers. Sorry, I am bringing us to fundamentals.
Yes, thank you very much, Mr. Innocent. So,
all right, thank you.
We'd like to discuss tomorrow. So, we want to tell us about the what do you call it, the double entry principle, and to also indicate when you debit this, what happened, when you credit this, what happened. A debit account, what are debit accounts, what are credit accounts? So those are the things we'll discuss tomorrow in detail. And why we also give example of how the balance sheet is formed. Like you just said, the current assets, the non-current asset, current liability, non-current liability, the equity. What are the things, how do we treat entries, transactions, and where do they sit? Those are the things we will explain tomorrow by God grace, 10 o'clock tomorrow, by God grace. So, Mohammed, do you have any question with regards to what we have discussed?
I don't have any questions, but I was wondering if it's possible for you to, send us this slide so that we can use it to revise.
Yes, I will send this slide to you. I'll send this slide to you. Just that it's not completed yet. Okay, what will happen is that I will add, just permit me to add tomorrow's section to it. Then if I add it to it, then I'll send it.
Okay, no problem. Thank you very much.
Thank you. Thank you. We have taken more than 2 hours. I'm correct. Thank you, Mr. Innocent.
Thank you
very much. Let's meet tomorrow, same time. May God bless all of us. Thank you very much. Bye-bye.
Thank you. Thank you. Thank you.
Thank you, sir.
Yeah, thank you.